Thanks a lot. Thank you very much. Welcome back. Making money in Las Vegas, Caesar's Palace. This is the place to be tonight because this is the crowd to be with. Thanks a lot, guys. Let's do it. Let's bring another guy up. Raphael. Hey, how's it going, Raphael?
Pretty good. How you doing?
Good. What's your question?
My question is, what are your short and long-term views on real estate, given the possible likelihood of interest rates going up in the near future?
I happen to like real estate. I think it should certainly be a part of your portfolio. I think one of the problems with the notion of home ownership is changed a lot. I'm hoping that changes back. Again, listen, the aftermath of that crash that we had, you can understand how people might be reluctant. But I happen to believe you should have some hard assets in your portfolio, maybe 5% gold/silver, some real estate, antique watches. It doesn't have to be something very expensive either. Something like that will be a store of value. Now, we do happen to have on stage with us right now, though, the man himself, a Las Vegas resident, Bob Massi, legal expert, real estate expert, and Fox News contributor. Hey, Bob, welcome to the show.
Buddy. Thanks,
and by the way, Scotty said he had better hair than her. I don't know.
Nobody knows my name, just my hair.
What do you think about that?
I think that we learned a lot through the crisis. We learned that certain people should never have bought a home. My concern right now is Fannie and Freddie are loosening up the regulations. I think that the American people, all of us, want to own, and that if interest rates go down and there's an ability to get into the buy, they're going to buy again because people...
Hold on one second, Bob. If interest rates go down...
I mean, excuse me, even if they go up.
Okay.
If they go up, it's not going to matter because people will fit it into their grid to be able to own again. Now, the lenders are still being tough, but with Fannie and Freddie loosening it up and things like that, I think ultimately the market's going to obviously correct itself. I'm big in real estate. I mean, buy low, sell high. I still believe in the real estate market.
Yeah. All right, so go for it. I think all of that meant go for it. Thanks a lot. Appreciate it. Hey, Lauren T., Spartanburg, South Carolina.
Hey, so I'm a student at the University of North Carolina in Chapel Hill. Go Tar Heels. And my question is, so like many of my friends have had to take out student loans to finance my education. And I'm just trying to figure out, when I do graduate, should I be concerned about paying those loans off right away? Or should I put my money into the stock market? Like, how should I kind of divide that up?
That is a fantastic question. I think a lot of people are grappling with that. But you do understand you're going to pay them. You don't think we're going to pay you, right?
Oh, yeah, definitely. I have to do it eventually.
All right. We love you. For me, it's one of these things. You weigh, what your interest rates are, and everyone has different rates. I think some of these rates that these kids have out there, the sooner you can pay it off, the better. If it's something that's manageable and you can make more money by putting it to work somewhere else. So I think it's almost an individual decision there, but it is certainly complicated. Personally, I'd like to see the government get out of this business. Since the administration kicked out the middleman, the loans themselves are $1.3 trillion, $800 billion of that on our shoulders, and hence all the time speaking of politics that they'll, wink, wink, you don't have to pay them. No, you're going to have to pay them. So I think it depends on you individually. If your interest rate is under a double digit, I would rather see you pay off a limited amount and invest the rest. Try to grow some equity.
Yeah, it's opportunity cost as well, because if your interest rate's only 5%, but you get 10 in the market, and you're paying that off, you're losing 5% a year, which is very, very big. And for me, mine was 3.5%. I'm still paying some of my student loans off and putting it in the market.
But one of the things is this is the reason why a lot of these millennials, the 20-somethings, post-grads, can't get a home loan. They're having to deal with this housing debt, so they can't win. So this is why you do want to get this paid off, because eventually you will want a bigger loan to take out, and will be penalized because you still have this outstanding student debt.
All right, guys, let's move on. Thank you very much. Appreciate it. Charles B., Toledo, Ohio. See, we like guys from Toledo. You're from the heartland.
That I am. Welcome to Las Vegas, Charles.
Thank you very much.
Most of us here have been to a lot of conferences and that. They're packed we all feel the bear market is coming. What do you and your panel feel will be the trigger that will cause the next bear market?
I'm not sure. They do come. Here's the thing, though. Here's the thing. Bear markets, to your point, are inevitable. I had booths at this conference in 2000, 2001, 1999. I see some of the same faces going around, grabbing a bunch of pens, and still waiting to make their move in the market. I mean, let's be honest, right? Because they're afraid of the next crash. If I'm lucky, I'll live through at least 5 or 6 more crashes, big crashes. So I think it's inevitable. So I'm not sure what the spark will be. We talked a little bit earlier in the show about some of the potential things, whether it was China, interest rates going up too soon, or just the fact that we are in a recession right now, unrealized and not talked about, that gets worse because the American public doesn't want to step up to the plate.
Yeah, don't miss the next 5 to 10% move upwards because you're nervous about the market crashing. What you want to do is be in it, and eventually, yes, we'll have that.
And we'll see some signs. Listen, don't be afraid if you start to see this thing crack up to get out, because you can always get back in. The key, though, is to get back in. So we appreciate it.
Okay. Thank you very much, Charles.
Thank you very much. Ben Paul.